Hi, and welcome to Peg FM Podcast. Today, we have the honor to have two guys that are very funny and very knowledgeable, Nigel and Ray. How is it?
Yeah, nothing like putting the pressure on, is it? It'd be funny.
Hey,
Let me get all my gags ready.
hey, good morning. Thank you so much for having us. Do you know, it once came up in the best man speech at my wedding, and my mate said, Nigel's a very funny guy. And he said, not in the way that your mother said you had to be careful about, but in the amusing way. So just to clarify, folks, yeah.
Just to clarify, so that's Nigel and I'm Ray. That's it.
Yeah. There you go. There you go.
Very nice to be here, and what an honor it is for you to have me. Thank you.
Oh, thank you. Thank you. So, guys, tell the listener, who are you? I know obviously who you guys are, but maybe people don't know, like a short background. Who should start?
First, Nigel?
Yeah, well, I mean, Ray and I got together. We're just a couple of sort of oldish blokes who are young at heart still, who have lots of grumbles about the world, and we feel we should be in charge of the world because we've got the answers. No, it's one of these things. We got together to help people raise money for their property or business ventures because you saw a lot of people struggle with it, and let's face it, everyone needs money. So we did that. Me as a background, I kind of got stuck in the mentality of the go to school, do your exams, get a profession and all the rest of it. And I found myself being an accountant, which was as big a shock to me as anyone else, I think. And I've tried to suppress my entrepreneurial spirit, but found I couldn't. And then a good number of years ago, met Ray, and we kind of hit it off because we both had similar outlooks on life, both had similar sort of ideas and having done a few things, but both always wanted to try and help other people and ourselves, win-wins, and try and get more out of life. I think we always had that similar outlook on life. But Ray will now contradict everything I've said, I'm sure. But there you go. That's me.
I've been self-employed in a variety of businesses most of my life. I have imported beer. I've had a restaurant. I've had a nightclub in Glasgow. So I know all about extortion and the drugs trade and how that works. I have.
It was very successful for you, Ray, wasn't it? They were your glory years, weren't they?
Yeah. I then did a law degree. Not with the intention of becoming a lawyer, but I did a law degree, and then I eventually went on to become a lawyer, qualified, and worked in corporate law for a while. But my entrepreneurial spirit kept bursting forward, and I ended up working with a company called Angel's Den, which is the world's highest network of private investors. I think it still is, and seeing and helping rate about 5,000 or 6,000 pitches. I mean, people pitching for money, and sort of narrowing that down. Then we formed Property Angels Den, which to do the same thing, to get private investors to put money into property. So this was about 2014, 2015. And then I looked for property training companies, not for me to be trained, but to find people who were looking for money, because property training companies are training people, what to do, but they needed money. So I went to see if the training was any good, and they invited me to become a speaker with them. And that's where I met Nigel. And then when they were doing or suggesting podcasting, I said to Nigel, why don't we just do one together? Because a lot of podcasts that I had listened to in sort of 2017, 2018, the ones that jumped out for me were the ones that people were just chatting rather than, the sort of set agenda. And if there were two hosts, it seemed to be better. That's what I liked. So I thought, well, we'll put it out there and, see what happens. And now we're over 116 episodes, I think. And so there we go.
Wow.
So we're still doing it. We're still, we've got the podcast. We're still showing people how to raise money and teaching and training and that sort of thing. And it's down to supply and demand. I mean, we're doing it because people ask.
Yeah. Me and my missus have actually learned a lot from your podcast. Like,
what to think about when raising money as well. So that's why I wanted to have you guys on the show. And like you mentioned, because I'm doing this show with my fiance as well, and they say like it's good when we like speak together, the dynamic, and from a women perspective and a male perspective, and yeah, yada yada yada.
I mean, yeah, those. Let's think about it. Those perspectives are really very closely aligned most of the time, aren't they? Between men and women. Because no, I'm going to stop there before I get. You've got to realize when you got to stop digging, haven't you?
You can see me I'm biting my lip over here.
Yeah.
Okay, guys, let's jump right into it then. So, as a developer or investor seeking funds, what should you have with you when attending a meeting?
Good question. Right. I was going to say, Ray, just before you go into the detail, I would say never, ever go into a meeting without working out what you want to get from that meeting. So if you don't go in with a plan for the meeting, we've all sat in them, they drift around for hours, and then you walk out thinking, I think the only thing we did there was arrange another meeting. So I'd always say, have a clear intention, what you want to achieve in that meeting. But Ray, what would you say there for details?
Well, I mean, it depends who the meeting is with. So let's make the assumption that the meeting is with an investor, a private investor or a lender. If it's with a bank, the bank have a very defined process. So they'll just want to meet you and they'll want to control how the meeting goes by asking you for all the information, and they'll tell you what to bring. But if you've got a meeting with a private investor, then usually to get that meeting, they will already have seen some information. So they should already have seen a one-page summary, for example. They would have liked the summary, then they would have asked for more information, and then they would have asked for a financial appraisal. So they should have all these things already. When they're inviting you to a meeting, the meeting is to see you. The meeting is to see, well, is this person credible? Do they know what they're doing? Can we trust them? Because they'll have all the other information. So I think you want to define what the meeting is. So if you say, well, you've called me in for a meeting, is there anything I need to bring? And they'll tell you. They'll just say, yeah, no, it's fine. Just bring yourself. We just want to meet you. And then what they'll do usually is they'll ask you a bit about yourself, your background, and all the time they're looking for credibility. Have you done this before? If you haven't done it before, it's going to be difficult to get funding, which is why we say you need to partner up with somebody who has the experience you do not have. But they're really wanting to see you. They just want to have a chat. Just right, hi, tell us a bit about yourself. Okay. And then if they like that, then they'll go into the details that you've sent them and say, right, okay, now you've said that you're going to make a margin of 23%. What happens if prices go up? What happens? They're just going to start pushing you and looking for what ifs just to see if you've covered everything off. That's really it. That's certainly my experience most of the time with most of the meetings. So I hope that helps.
Yeah, great answer, both of you. And what type of security do you usually tend to require when lending out money or investing?
What type of security?
Yeah, do you suggest or do you tend to give?
Nigel, would you want to cover?
Yeah, I mean, I just made a couple of quick notes, and for me, it's a really interesting one because people always look for a formula or something, but what you've got to appreciate is every situation may be slightly different. And I would say whatever is sufficient. So you've got to look at this and don't pile in with everything, because I've spoken to a number of people, and Ray will have spoken to far more, where they offered 15% and the person was kind of bowled over and actually backed off because they thought that was too much. And 5% would have done the job. So, in terms of that being the return, then the security beneath it, they'd say, and I'll put it on this property and that property and this and my firstborn and my house and the dog. And sometimes it's too much. So ask the question, what are you thinking? What sort of security do you typically use? What sort of security would make you feel comfortable with this?
A good question.
And have a chat about it.
Sorry to cut across, Nigel. A good question is to say, Mr. Investor, what's important to you in investing? Because they'll tell you. Because if what's important to an investor is the biggest margin you can possibly get, then they're less worried about the security. If the thing for them is, I mean, I have one guy and he won't touch anything unless he can get a first charge. If he doesn't get a first charge, not interested. And then I've got others that take nothing. So, personal guarantee will do fine. Do you want it backed up with assets? Do you want an asset list? No, it's okay. Just get them to sign my guarantee form. Because to some people, £10,000 investment they're going to watch it like a hawk. And then we've got others that put £1 million in and then they don't really care. So, it's Mr. Investor, what's important to you? And that will give you an indication. And then say, they will bring it up. I mean, we have a formula we talk about called the Crest formula, it's CREST, and the S of Crest is security. So they will usually bring it up. Now, if it's property, then the security can be a charge over the building, depending on whether the investor is the primary lender or the secondary lender or the mezzanine lender or wherever they are in the funding stack, then they'll be entitled. So the person putting most of the money in would quite rightly want a first charge if possible. Now, if that doesn't cover it, they may say, do you have any other unencumbered property? So property that doesn't have any charges on it, or a property that's got a first charge, but there's quite a lot of equity in it and it could support a second charge. So just ask the investor, say, what sort of security you're looking for. Now, if you're raising money for a business, it's usually the shares in the business. That's what they're buying. So they're investing in the business and they're getting shares for that. And then the shares may go up, they may go down. And in the UK, we have a thing called Enterprise Investment Scheme. So for some investors, the security is that the company they're lending to has been selected, pre-qualified by the Revenue and Customs as a company that's eligible for Enterprise Investment Scheme investments. And that gives them a certain comfort. So security can come in different forms.
Yeah, definitely. Very wide.
Just thinking about it, if when you're talking to an investor and the investor's fairly blasé about it and you sort of go, really? And they say, well, I know where you live and you have to sleep sometime, I would look for a different investor.
You are, of course, mentioning Mr. Ivanov from the Ukraine.
Ray knows about that from his glory days in the nightclub.
Yeah,
there's very little paperwork.
Very little. Yeah, only what you want as your hospital food, probably. But yeah, good question. Good question is that.
Good answer of both of you. Again, I'm loving this. I'm loving this. So, what are the minimum length you should give when you suggest this term then with the investor?
Yeah, minimum terms. Again, I would always say, Ray said it beautifully in the last answer, in terms of ask a question. And whenever you're sort of wondering what the person should do, don't both of you try and mind read, just ask a few simple questions. And what you'll probably find is if the conversation flows, then it will be reasonably easy to work out what each party values. And at that point, you will be able to sort of go, bring the conversation around to, okay, so are you a 12-month person? Are you a 10-year person? If you like 12 months, do you know someone that likes 10? Because depending on where you are on that spectrum, the deal is either going to work or you're going to be miles apart. And Ray, you've got a lot of people who like very short-term lending compared to a standard mortgage of 20 years. That's what they're after, isn't it?
I mean, the shortest we've done is a week. Somebody needed money for a week. It was because I think it was a VAT. They were getting a substantial amount of VAT back from the revenue, but it had been delayed over some admin technicality, and they had to complete on a property purchase, and they needed I think it was about £100,000, literally for a week. So that's the shortest we've ever done. Average would be 6 to 12 months for short-term lending. And then after that, we've had recently a number of investors who've put money in short term, but have been prepared to convert it to 3 years a term, because in the turmoil that we have at the moment, people are looking for stability. So the developers are looking for stability, as in could I use the money for a bit longer? Probably because developers who've got a bit of experience know that things always take longer than you imagine. I mean, I was talking to one yesterday, and he's building houses, and he's got some of the houses pre-sold, but the local council had decided that the name he'd chosen for his development, which was it was a new street. They built a new road, they had new houses, a new street, and they had to apply to the council for naming. And he paid his fee, which is about 450, 500 pounds. You pay a fee, and then the council tell you that yes, you can have that name, or no, you can't have that name. And they'd said to him, yes, the name. And then they turned around and said, no, you can't have the name. It's been voted against, so you have to reapply. Now, that might sound, well, that's a bit of a nuisance, but it has a knock-on effect. And the knock-on effect is that without the name, they didn't get specific numbers to allow the utility company to connect the power. Yeah. And that actually added about 3 months to the project, just that one thing. So, you know, you never know where these things are going to come from. That's going to delay things. Another one just last week, a deal had been done. The money was to be transferred on Wednesday, and on Wednesday morning, the solicitor on his way to work got run over and ended up in hospital. And the money is now due to be transferred today. Now, that prevented something happening on Friday that was very important, because they thought, well, it's coming on a Wednesday, we've got 2 days, so if there's a delay, we've still got 2 days. I mean, no one could account for that, for a lawyer getting, run over in the street. And it was genuine because...
I was going to say, as much as many people sometimes wish it would happen. No, come on, we all love solicitors. Yeah, they're all fabulous people. I mean,
we ended up the people on the other side sent us. It made the news, the local news. They blocked off the street, and it led to traffic disruption and things like that, and it made the news. So it just another one had development was all going nicely. And then recently there's been supply issues, commodities and supply issues. And they were waiting on the delivery of 18,000 bricks. And the bricks arrived, but they were the wrong color. They'd already built half, so they had this wall that was halfway up. And then the bricks that arrived were the color. So they couldn't, put them on top. So what they had to do was then demolish the wall that they'd already built and use all the new bricks to create that side-facing wall, and then take the older bricks, which now were obviously covered in hard cement, and then there was an additional amount of work. Do you see what I mean? Yeah. So those are things that when you add in contingencies for things going wrong or delays, most people would add in, I mean, if people come to us and say, we need money for 12 months, we say, well, I think you should borrow it for 15 or 18. And they're always, no, it'll be fine. Borrow it for 18, seriously. And if you don't need it for 18 and you can pay back earlier, that's fine. We'll make sure that you don't get penalized for paying back early. Yeah. But in virtually every circumstance, it's not every circumstance. It's about 50-50, I would say, in terms of going over the limit versus the ones that complete on time. Because, things happen.
Yeah. COVID happens. Shortage happens.
Exactly.
I totally agree with you. So what questions should a borrower be able to answer?
Good question, and the simple answer is all of them. But here's the thing. It's funny, Ray and I were talking about this just the other day on our podcast, and it's very tempting to try and give an answer to everything there and then. But you've got to appreciate what you do know the answer to and what you are not certain about the answer, at the moment, and separate the two and have a clear sort of point in your head where you say, right, I really don't know that. So just say, look, this is a great question. can I just ask why you're asking that? Because at the moment, I don't think I've got the answer for you, but I will get the answer to you by whenever, and then make damn sure that you do give the answer to that. If you are doing something and, you know, if you're under pressure doing the pitch, or you're feeling under pressure, sometimes just have a little piece of paper, a little pad and a pen in your hand, and just say, I'm just going to make a note of that, because that's a great question. So, and I'll put a date on, yes, and I'll come back to you with that. I think everyone appreciates that kind of response. We've all seen it on the TV with politicians when they try and give an answer off the top of their head. And what happens? It comes back to bite them when the very next interview, the next day, said, well, you said yesterday X, Y, and Z, and it's now A, B, C. So don't get caught out. Answer everything. You should be able to answer the vast majority there and then, but just say, look, that's a great question. Don't know at the moment. I'll get the answer to you by tomorrow. Is that all right? And if that's the case, then that's the best way to do it. Certainly, Ray, you don't want to start making up numbers, because we've all seen Dragon's Den and Shark Tank where they try it. It's not normally that successful, though, is it? It's great TV, especially as it zooms in on the beads of sweat running down their face. But but no, you don't want to go down that route.
Do you have anything to add, Ray, what Nigel said?
What was the question again? No, I mean, I'm kidding, but I do mean that as sometimes you need to ask someone to restate the question a different way, because you might think, well, do you mean this or do you mean that? And if it's one of those questions that's a bit ambiguous, it's over, you know, go back to the potential investor and just say, well, I'm not quite sure what you mean. The one thing to always bear in mind is this is a meeting of equals. You know, you're not there with a begging bowl. You're not there desperate for their money. You might be desperate for their money, but you know, you should not come across as desperate. You have to come across that, you know, they are looking to invest their money. They're getting something out of this. They have the money, but not the time or the knowledge to do this. And you have the time and the knowledge to do it. And you're going to give them a fantastic return on their money, much better than they're going to get in any bank or anything like that. So the one thing is, at the moment, there's a lot of cash around, an awful lot of money around, but there's not a lot of deals. I was talking to a guy just yesterday. He said, I've got £800,000 in the bank and I've got nothing to spend it on. There's no deals out there. I can't get any deals. Now, about an hour later, I phoned him up with one that he's going to be looking at today. In fact, that reminds me, I have to do an introduction to someone on that. But that's a common theme that's been coming through now. We're seeing people saying, well, I've got the cash, but there doesn't seem to be anything around. There are supply chain issues. There seems to be a manpower shortage. Are we still allowed to use the word manpower? Anyway, you know what I mean. The majority of builders are men, so it's not person power. It's, you know, tradesmen, tradespeople.
Yeah.
You know, and so that's leading to challenges in getting things done. Nigel knows someone, for example, who works for a consortium, and they put money into a project and it's gone a bit over because of commodities and things, you know, that sort of thing. So that means that they are unable to look at any other deals because they're bogged down in trying to fix the one that they've got. Now, if you're going to get a return of 10% or whatever it is, you're expecting that return in a period of time like 10 months, 12 months, 14 months. If that suddenly stretches out even further, there's also the opportunity cost that you're losing out on, because you know, people may come to you with other deals, and if you're bogged down, you know, it's a challenge. So it is a meeting of equals. The money is as important as the deal, but right now the deals, good deals and good teams who can deliver, I think, are in short supply, not money.
Yeah, great answer, both of you as well. So if you, how important is the return compared to the risk?
It depends. And it's like anything. If you're tiny, the molehill looks like a mountain. And if you're a giant, the mountain looks like a molehill. And it kind of depends where you are. But I'll give you an example here of different perspectives with regard to return and risk. So someone that has £85,000 in the bank and who is getting 1% return a year, they may look at that and say, okay, I know that £85,000 is guaranteed. It's not going to go away. The risk is zero, and I'm going to get 1%. And I'm happy with 1% because my living costs are fine. Another person might look at that and just say, well, you know, who knows what might happen? And 85,000 only getting 1%, this is crazy. And, you know, surely you can trade a bit of risk and get a better return. And even offering a 2%, you've suddenly had a 100% increase in the return. And maybe the risk is on a property instead of the bank, and the property is at 50% loan to value. You've got to start thinking, okay, what is this combination that people like? And for some people, they want a return of 15%, and the risk, they can have it relatively high. But that relatively high is only relative to those people that like zero risk. To him, he might be thinking, actually, this is still pretty risk-free as far as I'm concerned, because I've got 20 of these investments. And I work out that 15 will be all right, 3 will be superstars, and 2 will completely bomb. But my portfolio of risk there is kind of pretty low. Look at any one individually and you'd think it was crazy. But it's this weird sort of mix from where the person is and what they're doing. If you've got £1 million and you lent someone 10,000 and it was quite risky is what? It's only a perspective. When you've got £1 million, 10,000 is no risk at all, is it? It's not going to affect you. But if you only have £10,001, then putting 10,000, virtually all your eggs in one basket, could be seen as very risky. So it just depends where you are. And this comes back to what Ray was saying. Ask the questions of the investor. Yeah. You know, what would they typically feel is a good return? And, you know, how risk averse or, you know, risk sort of aware are they, and where do they want to be? Because it literally is different for every single person out there. And you can't really make a hard or fast rule. All you can do is try and tease out where you think they sit so that you can put it together. And then you make suggestions and say, well, you know, would you be happy with this sort of return and this sort of security on a deal? And does that fit within your risk profile? Does that fit within the returns that you're after? Or should we just nip down to the casino and stick it on one of the numbers? You know, what do you reckon? Come on, you get free drinks down at the casino. Who knows? Who knows? It's why we're all different, and it's why it's such great fun.
A couple of things about risk is, so first of all, about teams and their risk profile. And then secondly, about an investor I was talking to a few days ago and about his attitude to risk. So many years ago when I was with Angel's Den, or I used to work with Entrepreneurial Spark or some of the incubator startups, we'd see startups and there'd be 2 or 3 people on the team. I would ask them all to do a risk profile analysis, which it was an online thing. I haven't actually found it again. It used to be on a website called sherlawscoaching.com, but it's not there anymore. And I haven't looked at it recently because I don't work with startups a lot of the time now. But it gave you a score of between 1 and 10. So 10 being massively risky, you know, guy would get some money, walk into casinos, stick it on number 25 or whatever, that kind of thing, versus 1, which was take no risk at all, virtually not even leave the house, you know. And most people were in the range of sort of 3 to 7. You know, most people would be between 3 and 7. And the ideal team for a startup is you had one who was a reasonably high score, 6 or 7, and another one who was a reasonably low score, 3 or 4. That was a good team, good balance there. What you didn't want is 3 founders who were all at 7, because that's just a recipe for disaster. But you also didn't want 3 founders that were all at 3, because that would also, we would get nothing done. So most of the best teams I've seen have had mixed profiles like that. Now, on to the guy I was talking to the other day about risk, because he was doing something, or he was proposing to do something that seemed to me to be from my point of view, quite risky. Now, I'm entrepreneurial, so I would say I'm probably a 6 or a 7 when it comes to things. Maybe my wife would say I'm an 8 or a 9, but anyway. I just, oh, that's a bit much. And he said, well, like most investors, he balances out. He doesn't just put money into property or just into something. And he said, well, in the last 3 years, I've had 40% return on gold. I've had a 1,608% return on cryptocurrency. I've had a 12% return on property, and I've had a 5% return on the stock market. So he says, you know, as far as he was concerned, he was balancing everything out. And I said, wow, you know, why wouldn't you buy more gold or go into more cryptocurrency or something like that? And he said, well, because I only use a percentage of the money. I'm not going to put it all in. And he said, and I also have some cash. You've got to have a bit of cash. So he's also got a bit of commercial property. It was a commercial property deal he was looking at that seemed to me to be, you know, I just thought a little bit risky. I wouldn't have put money into it. And one of the things that we do when people come to us to look at using funding for something, me and the team, we always say, well, is this something we would invest in ourselves? And if it is, we'll promote it. We will put it to our investors. But if not, then we'll say, no, it's, you know, you need to go away and work on something. And we have a formula. And basically, the formula we have invites a score. So I have a checklist, and on that checklist, there are about 20 items, and each item has a score from sort of 1 to 10. So if a deal comes in, I'll have a look at it and I'll say, right, I think that's just without too much thinking about it. We kind of adopt an approach. There's a great book by Malcolm Gladwell called Blink. It's called The Art of Thinking Without Thinking. So when we look at something, I don't try and analyze it to the nth degree. I literally take 20 minutes and go, right, okay, is it a limited company? Yes, it is. Is there a decent team behind it? Yes, it is. Have they done something before? Yes, they have. Is the return offered, you know, can the deal support the return? Yes, it can. Have they considered all the exits? How many exits have they got? Are they selling? Are they renting? Are they, you know, and the more they've considered, the higher the score they get. So once I've done all that and add it up, if it gets 95 or more, we go ahead with it. If it doesn't, we look at the areas where it falls short and then go back. So it might be that, you know, your team's not credible enough. You don't have enough experience. You're borrowing too much. It's above a certain percentage level. You're not putting enough of your own money in, or whatever it happens to be. So it's a combination of logic and emotion, but mostly because it's money, it needs to be mostly logical. You know, does it stack up? Does the financial appraisal stack up? Yes or no on a first pass? Because there's a tendency that startups and some developers tend to have is if they get emotionally attached to something, they adjust the figures to suit. You know, they'll put in and say, well, I've been told it's £1,700 a square foot, or sorry, a 1,700 square meter, which seems to me to be a bit high. I'm going to knock that down to 1,500. Now it works. You know, and the contingency at 5%, it's a bit much. I'll knock it down to 3. You know, things like that. Now it works, and that's the wrong approach to take. It either stacks up or it doesn't stack up. So when there's a large amount of money involved, although people can be risky, they'll usually run it past someone who does financial appraisals and say, right, run that past. There's a bit of software that you can get access to, which allows you to do financial appraisals. And you just put in the square foot area, you put in, you know, what you want to do, if you want to sell it, et cetera, all that, what you're buying it for, what's your property taxes, what's your professional fees. You just pump all that in, the figures, you know, and it will tell you if it works or not.
Yeah.
And the figure at the end is either in green or it's in red. And if it's in red, you don't do it. Simple as that. So whilst people can be risky, a lot of the investors have accountants and lawyers, and they'll say, well, I want to do this. Is there any reason why I shouldn't do it? And the lawyer or accountant will come back and say, no, it looks quite good. Or, and there's one guy in particular, his accountant usually always comes back, tells him not to do it, and he does it anyway every single time.
And how has it gone for him?
And I said to him once, I said, well, why are you taking his advice if you're not listening to it? And he went, well, he's the accountant. He says, I'm the one that takes the risks, not him. I pay him anyway. He gets paid anyway at the end of the month, no matter what happens. So to make sure I've got to keep paying him, I've got to keep taking risks.
That is true. Just one little thing in there. You could always, because I've done some stuff where we weren't too sure if we had enough sort of strength in the team, enough experience, and you kind of look at the return, you go, well, I could get 12% if I did this, but if I added this person to the team, it probably enhances the strength of the team, probably reduces the risk of problems happening, but the return might only be 10.5% if that person comes in, you know, adding that cost. And you might sort of say to someone, look, we can do this, but it hasn't got this person. What's your opinion on this person? Do you think it would be of value? Would you accept a slightly lower? And you could give people options, and they'd say, no, go full ahead. Let's see if let's gamble on the 12%. Or some would say, no, that's a sensible appointment. 10.5 still beats my criteria. The risk and return works for me. So there could be ways of you know, adjusting both of those to make it work.
Yeah. Good answer, both of you. Again, you're on a roll.
Ray, we're on a roll.
You're on a roll,
Ray. Hey, this is where the wheels come off.
So following what you say, Ray, regarding the different asset classes, have you seen that people are more towards like crypto and meme stocks and etc., and like discouraging property now during this COVID period, or people still want to invest in property?
I think keep investing in property until a taxi driver tells you. Once a taxi driver tells you to invest in property, get out. That's a golden rule, you know. I think it was J.P. Morgan that said he's avoided back in sort of 1900s, late 1890s, early 1900s. J.P. Morgan, big financier in America, and he said, when the shoe shine boy started giving me stock tips, I pulled my money out. When the shoe shine boy started giving me stock tips, I pulled my money out. And he said that saved him on many occasions. Just because, you know, just because. So at the moment, if people are fearful of property, which they're not, incidentally, certainly not in the UK. In the UK, we've seen a boom, which no one was expecting. They think it was all driven by the fact that the Chancellor in the UK reduced stamp duty. But that had the effect of actually driving up prices because more people were now in the market. The UK also has the advantage of a stable economy. You know, so from all around the world, people look at the United Kingdom and it's got a stable government. It has a government that's never, ever defaulted on a debt, ever. And it's a good place basically to buy and store money in assets. And there's been a lot, certainly people I've spoken to in Liverpool, Manchester, and in London, there's a lot of money that's coming from Hong Kong. So people in Hong Kong are fearful of what's going to happen there. They want to get their cash out while they can, and they want it to be in bricks and mortar, you know, safe as houses, all that carry on. It's not sitting in UK banks because in 2008, we had a run on the Northern Rock Bank when people were queuing outside. And then also people are afraid that a government, it happened in Cyprus where the government just turned around and said, right, you've got savings, but we're taking 20% because we're in a pickle. Thanks very much. Just like that. So, and in UK banks, your money is secured up to 85,000. Unless you put it into a national savings bank. If you put it in the national savings bank, it's secure up to 1 million. So some people do that. Generally, though, it's seen to be safe to put money into property. So cryptocurrencies and gold and things like that are asides. You know, just about every investor I know has a valuable painting. They have valuable watches. They've got a valuable car. They've got, you know, valuable artifacts. They've got some crypto. They've got low-cost index funds. They've got insurance policies. Things like that. They generally, it's you know, wise to spread the risk, if you like. And as they get older and as they develop more wealth, they start looking for different places to put their money. And at the moment, impact investing is quite high on the list. So in other words, people are saying, well, you know, I can invest in affordable housing, for example. I'm not going to get a massive return, but I'm still going to get a yield of 3 to 5%. But if I put it into commercial, I might get a 10% yield. Or if I put it into residential, ordinary residential, I might get an 8 to 10% yield. So they're prepared to put it into different things for lower yields just because they can and because it makes them feel good.
Yeah.
So, yeah, but in terms of crypto, most people, once they've got the hang of it and know what it's about, tend to put in, I mean, I know guys that are multimillionaires, but they wouldn't have any more than about £100,000 in it, something like that, because they just want to know how it works. They don't necessarily see us making money from it, but they want to know about, some of them are still very skeptical about blockchain and wallets being secure and all this kind of carry on. And they will have Bitcoin and they'll have Ethereum. And some of them have invested in others that we don't even know about, you know, Dogecoin or Rally or something like that. I mean, I know a lawyer, for example, he bought a thing called Gary Coin. Yeah. He put $250 into Gary Coin earlier this year, and it's sitting at 13,500 now. You know, so because the guy behind it's promoting it, it's run by a company called Rally.io. I'm not promoting it. I have some. I put in $50 just to sort of, you know, to see what it was about. And it's purely because of interest. I just want to, you know, I want to be in it so that if anybody asks me about it, at least I have, I can at least say, well, I know how to set it up and I know what it's gone up and etc. I mean, I have some gold, not much, but I have some, you know, gold. I joined a club a few years back, and it basically all goes to my children. You know, they're sitting there with these, and it's, you know, you can buy them in packets of a gram. You know, they're worth about between 40 and 50 British pounds. Just things like that. So you'll find that most people will, of a certain age, investors that are sort of 60, 65 and above don't seem to have much interest in cryptocurrency or anything like that. They're not interested. But younger investors, and when I say younger, I mean certainly 50s, 40s, they all have something, but not huge amounts.
Okay.
Yeah, I mean, it's a weird one. I've put some money into crypto. I've got 21 different types of crypto in this wallet here, and it's up and down like a sash window, to be quite honest. But it's great.
I'm glad you used that as to describe up and down and not the other.
Yeah, I was thinking of something else, but you probably knew where I was going, but I got nervous there. But yeah, it's great fun to watch. But here's the weird thing. In the UK, you have something called IFAs, Independent Financial Advisors. And for years, I don't know if it's changed, but for years, they classed property investing as the highest type of risk, and they therefore never, ever advised anyone to do it.
Yeah.
And you look at it and you think that is the most ridiculous thing ever, because it was only if, you know, when you do, like you were talking about, Ray, the risk profile, what's your attitude to risk? It was only if you went off the scale, might they sort of tentatively maybe think about looking at, wondering if you might want to have a look at a house. And yet you look at the thing in the UK, we're an island, there's increasing population, there's limitations on how many houses you can build and the actual physical ability to build these houses. So that at the moment, the demand is always outstripping the supply, which means fundamental economics, prices go up. So why do IFAs not, you know, get into the properties? It's a weird one. So we're in this crazy thing where everyone who looks at IFAs and goes, why am I taking advice from someone who is just above broke? You know, about how to invest in wealth. It's crazy. And I know a number of people who have gone into the bank and they're at the counter, and the person looks at the account and says, oh, you've got some money. Would you like me to have a chat with you about how to invest it? And they kind of look at the person thinking they're about 23, and I bet they've got student debt and no money. Remind me, why would I like to have a chat with you about how to invest money when you don't have any or the experience? So it is dependent on the age and the attitude of the person, but yeah, it's you know, it's a funny one. Is this? It's a funny one. We get such contradictory things. Buy gold, don't buy gold. Yeah. Buy crypto, don't buy crypto. You're a nutter if you buy crypto. You know, and your head's in a spin. And sometimes you just got to take a step back. And as Ray again said earlier, take a logical approach to it and think, okay, what's my attitude to risk? What sort of return would I be happy with? If I get 8% on average for 10 years, I've doubled my money. So you've got to just take these steps back and go, what's my time horizon? If you're 95, you're probably not going to get, you know, some 25-year mortgages. It's unlikely. But if you're much, you know, younger, then you look at your time horizon, look at an average return, and then think, what's the risk in that? And that's when you can start making some better decisions. But nobody teaches it at school that I'm aware of. My kids certainly haven't come back with it.
No.
The only thing they teach them at school is, you know, what do you want to be? And the answer from every kid is a YouTuber at the moment. And you sort of think, at which point the teachers sort of dismiss that. And you're left stuck with you know, I don't know what they're going to do. And here's the weird thing. I still don't know what I really want to do. And so I'm looking back at my kids thinking, do you know, I can't give you any advice on this because I haven't worked it out myself yet. And I'll give you an example. My form teacher, when I was 16, appeared in the news of the world because whenever it was games, I love golf. It's Ray's favorite sport, although he's in denial. But I used to, you know, he'd call the register and say, what are you going to do for games? And I would say golf. The reason was there was a little golf course near where I lived, and me and a mate would go, we'd hit a couple of shots and then go play snooker. Obviously, no, we did play golf, honestly. But whenever I mentioned golf, this teacher would say, golf, what are you wasting your time at? I'd say, it's a good sport. And he'd say, it's only for people when they're retired and near death. And I thought, well, that's a bit harsh. Anyway, he appeared in the news of the world, a big Sunday newspaper, center spread. I was the guy who told Colin Montgomery he should give up golf because he went to my school as well. And this same teacher told Colin Montgomery, golf, what a waste of time. You'll never be any good at that. So
Colin Montgomery was one of Scotland's finest golfers. Did he win an Open?
No, he never won a major, but he won the tour, the Order of Merit, I think something like 9 times.
Yeah, millions of dollars anyway.
Ryder Cup winning captain, Ryder Cup winning player, you know, and he's won on the senior tour, he's won loads of majors. So yeah, the multi-million-pound Colin Montgomery, thankfully, didn't take the advice of my school teacher. So there we go. Sometimes the advice we get from the people that we think are in the institutions and not necessarily the things that we need to do. So there you go.
Just a story about crypto. I think it was summer or spring 2017, I attended an event hosted, no, it wasn't hosted. One of the presenters was a guy called Dr. Garrett Heilman. Now, Dr. Garrett Heilman is sort of professor of cryptocurrency at Crypto University Oxford or Crypto House Oxford or something like that.
On the planet crypto.
On the planet, yeah, anyway. And he came along, he's sort of American guy, lives in the UK. I get mixed up, Oxford or Cambridge. It was one of the two. It might have been Oxford Polytechnic, I'm not quite sure. But anyway, he gave a very good presentation on crypto for about an hour, saying where it came from, how it started. He showed in layman's terms how the blockchain worked. And it was a real eye opener to me because up until that point, it was just, I had no clue. And he said, he said, here's how you open a wallet. Here's how you do all these things. And immediately I went and opened a wallet and I bought a small amount of Bitcoin and a small amount of Ethereum, I think. When I say a small amount, I think it was £200 or something. And over the course of the next few months, I ignored it. I didn't look at it. I had a thing called Coinbase where you could look at it, but I hadn't opened the app in months. I hadn't opened the app, and my 200 was now 900 or something. And I thought, okay, well, I'm going to take my 200 out and leave it in. And now so I learned how to take it out and just left it running. And then, of course, it started, I think then it was about £15,000, which it's at 28,000 now or something, pounds.
Wow.
Sterling. So it was at 15,000 or something. And I just kind of left it. And then I was doing a presentation in Leeds, actually. It was a property event, but I was on the stage and somebody asked me a question about crypto. Did I know anything about Bitcoin? And I said, and this was true, I said, I got my first Bitcoin for $1. For $1. And I have it here in my pocket. And I took it out. I was searching for it there while you were talking, but it's a big circular coin. I mean, I'll go and get it in a minute. When Nigel starts talking, I'll disappear and I'll bring it back so you can see what it looks like. But whenever you see a representation of Bitcoin, they always show you this coin with a bead on it. Yeah, right, you know. And I had one of those coins. It's quite big, right? It's chunky enough. And I said, well, actually, I have one here on the stage, and I held it up. And I said, can anyone in the audience tell me what a one Bitcoin is worth right now? And someone said $17,000, whatever it was, 17,200 and something. And I was like, right, okay. So to tell you what I'll do, I'll tell you about Bitcoin and how it works for 5 minutes, which I did. And if anybody wants to buy this Bitcoin, I'll sell it here today. And people started bidding. They said, I'll give you £200 for it. I'll give you £300 for it. I'll give you £400 for it. Now, one half of the room were kind of giggling, right? And I was looking at them as if to say, shut up. and the other lot were getting in a frenzy to try and get this Bitcoin. Anyway, I said, look, I'm going to stop it at £500, right? So who's first to bid? And before I even said it, someone went, I'll have it, £500. £500, right, fine, fantastic. I said, you absolutely sure you want to pay £500 for this Bitcoin? Yes. How are you going to pay me? I'll transfer the money right now, all the rest of it. I said, right, okay. So thank you for that. But I did not mean to, make you feel less than or try and humiliate you or anything like that. But this is why you need to have knowledge. You need to get knowledge about how things work and not just take it from me because I'm standing on a stage here telling you in 5 minutes. And I said they ought to take time out and go and see a talk by this guy, Garrett Heilman. I think you can see it online now. You'll be able to see it on YouTube probably. He's certainly got a website. I said, you ought to, because this Bitcoin, I'm correct. I did buy this for $1, but you can also buy it for $1 because it is a representation. If you want an actual Bitcoin, you have to have a wallet. You have to purchase it through the blockchain. You purchase it through Coinbase or someone like that. Yeah. And you see them go, okay. And I said, so, it's a sort of wake-up call that you just need to be aware. Now, about a couple of weeks later, I was with an investor that I met. I was at his house and I was talking to him, and he asked me if I knew anything about Bitcoin. So I did the same thing. I said, well, actually, I have one here. I said, Bitcoin at the moment. And I went onto Coinbase and I said, look, it's at 17,000 each. And he's like, 17,000 for one. And he didn't understand it. And I said, yeah, and I have one here. And I took out the coin. And he's like, wow, that's fantastic. And I said, but I'm going to give it to you. And I gave it to him. And he's like, you just I can't believe this. I can't believe this. And then I told him, and I said, well, actually, it's not worth anything. Look, you can go to eBay and you can buy one there. But he then said, well, I've got something for teaching me, for educating me. And he went away and he brought back this. I don't know if you can see that.
That's a coin.
It is
gold coin.
Gold coin.
Yeah.
It's called an angel coin.
Oh.
If you can see that there, but
yeah.
It's very old, right? Yeah. It's an angel coin. Now, it's not in particularly good condition. No. If it was in really good condition, it would probably be worth about £5,500 or something.
Oh, wow.
But this one might be worth, I don't know, £1,200. So it's called an angel coin, which was the precursor to gold sovereigns. Now that, in King Henry VIII's time, that was a sailor's salary for a month. That was a sailor's salary. And the reason this guy had them is he had put a lot of money into, in the early 80s, raising the Mary Rose, the ship that was Henry VIII ship. And it left whatever harbor it was. It was launched, but it was top heavy and it just collapsed into the harbor and hundreds of people died. Yeah. But on board that ship was a lot of angel coins. So when he sponsored the Mary Rose to be brought up and recovered and all the rest of it, they gave him a number of these. I don't know how many, but he had quite a few anyway. That was kind of his share of the booty, shall we say. So he gave me one for teaching him about Bitcoin. So there you go. And while Nigel's talking next, because he'll
well, I just want to
bring the Bitcoin.
Yeah, I just want to add into that. Ray, what a fantastic story about how to raise money by bringing in a 400 or 500-year-old wooden ship that had been raised off the seabed. Perfect, my good friend. But what you don't understand is how much Ray used to love doing that Bitcoin thing. I'd see him on stage, and honestly, you'd have people coming out of their chairs trying to rip it out of his hands, going, he's giving away a Bitcoin for only £500. And it is so true, isn't it? You know, you can see how people fall for scams and all sorts of things when they just let that emotion sort of, you know, rule their head and their heart and everything else, and they go in for it. But this is where the difference comes when you're pitching to seasoned investors, because if they don't understand it, so the vast majority, if you're talking about crypto, they just go, look, I don't understand it, so I'm not going to do anything at the moment till I do. Whereas a lot of other people jump in far too quick. But there it is, with the B with the double line on it. And he would love to do that. And he would say to me before, you know, when we were doing different stages or whatever, talking to people, he'd say, I'm going to do the Bitcoin thing. I'm going to do the Bitcoin thing. So I think you
buy them on eBay. They come in a little bag like this.
I think you gave me one. You gave me one.
$1. They're $1. I bought about 50 of them just to give away.
Yeah, I think you gave me one, and I tried it. And people just, they're almost bowing down. You have a Bitcoin? Whoa!
I think I can trick my mom with that joke.
Also, I found one of that's one of the cards with the gold in it. I don't know if you can see that there.
Yeah.
A little gram of gold.
Yeah.
So my kids have a couple of those. It was beside the Bitcoin.
So what are the most common mistakes you see with funders or borrowers?
Back to the serious subject now that we've gone from that. One of the things that you've got to realize is if you set Ray going, he's like an electric vehicle. He's off, and you've got to wait till the battery runs out. And
That's Nigel. It's the Energizer bunny.
Yeah, so we'll plug Ray back in so we can get another few hundred miles out of it. Right, I was making a note on this. I would say the mistakes that often people make are they don't ask for enough money, and they underestimate how long they might need it. But I'll let Ray expand on that. But just two things there, because we know about property, it always costs more and it always takes longer. So this is where I'm sure Ray's got, he'll recall some examples of where people think they've got enough, and then they're in a dilemma because, you know, I'm involved in one at the moment where we've put money in, and the person is now, it's taken longer, the costs have gone up, and now they're looking to get more money, and people are looking at it going, and this is a problem. And when it comes down to the fact that you need money in a hurry, then the cost of that money typically goes up. But Ray, you've probably got a few examples of that sort of thing, haven't you?
Yeah, I mean, lots of examples. We had a developer that came to us, had put a lot of his own money into a deal, also had money from an established bank, which is always good because it means that the bank have done their diligence and have stress tested it and all the rest of it. And he had an investor that was putting in 100,000 to finish off the stack, as it were. And I think the investor's 100,000 was working capital or something like that. And the deal had completed and the property was there, but the investor was unable to come up with 100,000. So they contacted me and said, look, you know, we're not in a pickle that we need it now, but we are going to need it because we've bought the property. So we've got a good 6 weeks before we will actually need these funds. So we want to raise 100 grand. So I said, right, okay. So we got the one-page summary. I sent it out to investors. And 7 investors came back offering 100,000. And I can't remember the terms, I can't remember the percentage or anything like that, but there were certainly 7 that were interested in it because it was a good deal. It was a, established track record, plenty of credibility there. The return was decent. The exit was all refined. There was no security in the sense that all they were being offered was a personal guarantee, but the personal guarantee was backed by assets. And although you had to give a personal guarantee to the bank, you can get personal guarantee insurance. So a very little known thing, but you can get that. Now, you can only get it if you're borrowing money from an established lender. You can't get it if you're borrowing it from a private individual. But anyway, so he had 7 offers, and he said, well, that's fantastic. I'll take 1. I said, my advice to you is to take 3. Take 3. He said, I only need 100. I said, no, I think you might need 3, and the deal can support it. It ended up he needed 4 over the term. Yeah. Again, as we would say in the law, a concatenation of events where things just happened.
Yeah.
For example, they were doing the groundwork, and I don't know if you remember a couple of years ago, it was wet for months on end. It just poured with rain. I mean, it wrecked the farmers and all that kind of carry on. Well, his groundwork was just absolutely ruined. And that added something like £160,000 already, just that one thing. Yeah. Then there was some other challenges and all this kind of Anyway, so he took the 300,000, which is just as well. I said, look, you're better to have it than not have it, and come back for another 100. But in the interim, the properties were built, and the stamp duty reduction kicked in. And instead of getting, I can't remember the actual figures, but instead of getting something like £300,000 per property, he got nearly £400,000 per property. So it all balanced out. It really did work out fine. But that's sort of an example of underestimating it. You will usually all need more money. You're always better to have more than not enough.
Yeah.
If you're also working with one investor, let's say, it's helpful if that investor has more money available. So again, we know the guys that are like that. It's mostly, I mean, there are a few women in there. It's about 80-20 percentage of men versus women who are investors.
Yeah.
And I have to say the women are much easier to deal with, but that's another story. I forgot what I was going to say there now. The women are better. Yeah. I forgot what I was going to say. I've lost my thread.
Women are better at most things. End of.
You hear the women listeners.
Yeah,
before that. Sorry, I remember.
They don't forget things. They don't forget things mid-sentence. That's for sure. God, I've forgotten again now. Right. It was about investors putting money in, and you want an investor who has deeper pockets than you might think. So what we'd often say is to someone, look, you're putting 100,000 into this. There is a chance that they're going to need another 50. If that does happen, are you available to put it in? And they say yes. So it's better to go back to the original investor than to try and find someone new, because the original investor's got to, they know you. Hopefully you've kept in touch. You've kept them informed of what's going on. They've already done their diligence. They've signed the paperwork. It's much easier just to sort of add in another bit of paper that says, okay, an additional 50,000 on all the conditions and terms that went before, something like that. It's just simpler. So we would usually look to them to do that. So hopefully that helps.
Yeah. So as you're aware, people are documenting their journey, like on social media and etc. What are your take on that? Do you think you should do it, or should you not do it, or what's your take on it, guys?
I was going to say, I'll give my opinion. I always say to people when they're doing something like this, record it in the moment, because you can't recreate the emotion that you're going through, but you don't necessarily need to release everything as it happened. And it's very interesting, not only for, you might never release it, but it might be very interesting to give you a confidence boost when you're in a down moment and you're thinking, I'm no good at this, I'm no good at that. Just look back at some of the things from where you've come from to where you are now, and you'll suddenly we're very good at blanking out our positives and only focusing on our negatives. So you've got to sort of have a look back at some of the things that were a success and raise a glass to the successes that you get. But here's the thing. I reckon that you can do irreparable damage if you put the wrong stuff out. We all know it. You build a reputation over 20 years and lose it in 20 minutes. And one of the things that amazes me is people that put something out going, oh, I've managed to get, I can't believe it. He fell for it. He gave me £100,000 and now I'm putting it into this property and I haven't a clue what I'm doing. Isn't it amazing? And, you know, that sort of thing. And people do it. And you just think, what are you doing? And one of the things that I've got a business and there's over 100 staff in the business. And one of the things that you will see is, you know, at times, people do the daftest of things and they can be the most wonderful person, but they can do the daftest of things. So people who say, can I have a day off? Well, no, you can't really, because you haven't given us, you know, enough notice and et cetera, et cetera. And they go, oh, okay. Next thing you see is everyone in, you know, coming in saying, have you seen their posts on Facebook? They went out partying. They did a 15-hour party. And you go, I assume they phoned in sick then, did they? When they couldn't get the day off. And you look at it and you just think, folks, you're shooting yourself in the foot. So however you document it, just think, what would be if you were an investor and you saw that person talking in that way about how they've used your money to do whatever they're doing, how would you feel if that was you? And if you think, actually, they probably wouldn't look on that in too great a way, that might be a bit of a career limiting moment. You know, you just think, right, well, just hang back. So keep it for yourself. And it could be that you then put a compilation together, because I'm going on a bit here, but here's the thing. A lot of people talk about the beginning and, oh, I've just secured this property and it's going to be this and it's going to make a GDV of, you know, gazillion pounds and it's going to give a 2 million% return for all my investors and all the rest of it. And they talk about that. And then you think, gosh, I never heard how that went. And then what you do is you dig a bit and you find out that the thing all went wrong. Funny, they're not talking about that. So maybe document your journey, and when it's all done, dusted, people repaid, you know, targets hit, outcomes met, then you put together a nice little presentation, snippet it up and say, here's one start to finish. Because Ray, people, investors, they do due diligence on you, and that involves looking at your digital footprint. So my thoughts are, do it, document it, but just be careful with what you then share with people.
Good nugget. Good, really good.
I think what always goes down well is, here's what I did and here's what I learned. This is what I did and this is what I learned. There are a few people I would say taught, but certainly imparted some knowledge and coached when I used to run a course called Raising Angel Finance, and we now do how to raise money. And in that, we do talk about your footprint and the things that you should be putting out there. And yes, it's good to show pictures of the keys if you're buying property, you know, jangling the keys and this is the property I bought. People love before and after things. People love it when you go with a camera into the drains and into the roof space and all that kind of carry on. They love it when you do one walking through the house or through the property. But they also like to hear about the things that have gone wrong. You know, there was one guy I know who posted, he recorded a video with a surveyor that came round, and he blanked out the surveyor, and he didn't identify the surveyor. But it was a really interesting video because you were a fly on the wall. You're a fly on the wall documentary while this surveyor, who quite frankly was a bit of an idiot. And if I tell you it was a council surveyor, you'll probably, you know, you'll understand where we're coming from. You know, they never offer any suggestions. They only shoot down yours. You know, it's simple as that. They're not paid to be creative. They're paid to put obstacles in the way, paperwork in the way, and that sort of thing. And this guy was doing it. It was a real masterclass in a job's worth. But the person that was recording it, because they were recording it, I think that made them keep their cool, because they were very cool. mean, I was watching it and I was getting enraged by it and thinking, why isn't he, you know, you want to scream at this guy and kick him off your property and all the rest of it. But he was being very calm. I think the surveyor was even trying to goad him into a reaction. It seemed like it, but it got, you know, masses of hits, you know, hundreds of thousands of hits. So you never know what's going to go viral, but you do have to remember that whatever you put out there is going to be there forever. I took a stance many years ago that I would only ever put anything out on social media in writing or imagery or videos or anything like that, that I was prepared to see on the front of a national newspaper or that my mother would see. So there's very little swearing, the profanity, things like that. I mean, you know, Nigel's absolutely right. You can record something in the moment to capture the emotion of it, but you have to then look at it later and decide whether you're going to post that or not. And just remember, well, what's the outcome of this? What's the worst that could happen? Is this helping me or is this hindering me? And get someone else to take a look at it and say, what do you think of this? You know, before you post it. But too many times people do Facebook Lives and things like that. And if you're not properly trained in how to do, you know, media, which most people are not, then, you know, and the people say, oh, they like it because it's raw, you know. Well, people do to a certain extent, but at the same time, you know, if you're going to come across as credible, then you need to, you need to come across as credible. You need to, show put forward a good front, a good face.
Yeah.
I have a call I need to take. Bear with me 1 second. Sorry, Nigel, speak.
Great. There went Ray.
There we are. I'm just at his mercy, aren't I? I'm just his plaything.
But I can ask you the question, and I mean, how, you as mentioned, the social media. Which platforms do you see that are like that you should be on, and where you can find investors on? Where do you see?
Yeah. The plethora of platforms frightens the life out of so many people, doesn't it? Because it's whichever one you're on, you always see stuff that's telling you you're on the wrong one. You need to learn this one. You need to be doing this, and you need to have that, and all these things. And people just get hugely confused. And for a lot of people, creating content or valuable content on any platform is hard. You know, we include ourselves in that. We're building up ours now. And one of the things is where do investors hang out? Well, it's a great question and very difficult to potentially narrow down. The obvious ones would be LinkedIn, because that's got a much more business type feel. It depends what you're looking to do and where it is. Can you ignore Facebook? There's 2.5 billion people on Facebook. There's Instagram tied in with that. But then you look at LinkedIn, there's probably 1 billion people on that. TikTok, there's a lot of people who have given financial advice who have got millions of followers because they give simple advice and people like it, explainers and things like that. So it really depends what you're trying to do. Are you trying to build your credibility? Are you trying to build your fan base, or are you looking for just a handful of investors who are willing to actually do it? Because what would you rather have? 5 investors willing to invest, or 5 million followers who just enjoy what you do?
Can I just say, sorry, Nigel, it's a lawyer I've been trying to get, and I need to speak to them now for the next few minutes. So we can stop the recording here, record an ending if that's okay. Is that all right?
Yeah.
Or we'll see how long it takes.
Or,
but
yeah, I'll keep chatting. You have a go, okay, and then come back. So you've got to say to yourself, do I want 5 investors willing to invest in me, my projects, to help them get a return and me grow the business or the property portfolio, whatever it is? Or do I want 5 million followers for vanity? And one of the weird things is a lot of people, or a number of people, will look at your following on Instagram and see if it's mirrored on Facebook or on LinkedIn or on TikTok or on whatever it might be, whichever platform You want to put it on YouTube. Have you got loads of followers on YouTube? And if you've got a big following on one but not on others, people sometimes have that disconnect. Oh, why are they not on the others?
Yeah.
But it all depends who your investor is. Is your investor going to be interested about what you're doing? Well, there's a couple of things. Why do big brands advertise all the time? It's to just keep you at front of mind, isn't it? It's to get that brand recognition. It's to get that name. So if you're constantly talking about some of the things that you're doing, and it could be, right, we're doing this, we're doing that, and it's consistent and it's over a number of platforms, some of the major platforms, then the chances are that when your investor does due diligence on you and looks at your social footprint, it will see things that are consistent with what you have been talking to them about and what you say you can do. And it's one of these things that you're just trying to make a tick, aren't you? You're just trying to reassure people. Ray and I talk about the Crest Model. So C for credibility, returns, exits, security, and trust. And you're looking here about credibility and trust. So what you're wanting, when I said earlier, I've got this money, I don't know what I'm doing, but I went out and I bought a car because that'll really help put a roof on this house, sort of thing. That's chaotic, and it doesn't give the credibility or the trust. So all you're trying to do really in your social media, your digital approach is to build your credibility, to show what you're doing. As Ray mentioned, show what you've learned, show how you are helping people. And then the trust element is, and here was a completed deal. This is a testimonial from the person that invested. Here's the return, and that sort of thing. So have a bigger picture, first of all, as to what you're trying to do. The platform, to some extent, is less relevant than the message that you are trying to convey on whatever platform it is. You can always tweak things so it appears, fresh on different platforms, the same thing, but just tweak it a little bit. But it's the message. What's your message? What are you trying to tell people about you and how you can help them? So hopefully that gives you an idea.
Yeah.
And, some people love certain platforms and some people have big issues with some platforms. I think what you need to think is, okay, I need to separate issues I might have with a platform with the reach that platform might have.
Yeah.
That could help me with my business.
Yeah.
So yeah, I know people get very uptight over platforms, very uptight over those businesses. I think if you look at any business in the world, you will find a murky or less than fantastic backstory to them. They are what they are.
Yeah.
It's how you leverage it for your particular business, though.
Yeah, I totally agree. And that was a really good answer to it as well. So how important is experience?
Experience, people panic over, and they feel that if I don't have experience, I can't do it, and everyone will see through me. And I think it's that imposter syndrome. And sometimes there's ways around it. So depending on what you're trying to do, okay, crypto, up until recently, nobody had experience in crypto.
Yeah.
So you can gain experience relatively quickly. Property, it's been around for obviously thousands of years. And, if you're asking to say, I want to do a development of 24 houses, people are naturally going to say, okay, what have you done in the past? Well, I've rented a 2-bed house for the last 2 years. And you go, okay, there's a big gap here. How do you get around something? Does it mean, oh, that's it. I can't do it. No one will invest in me. No, what it means is you have to then think about who's the team that I could put around me that covers for my lack of experience in this particular bit. But, to an investor, they go, yeah, okay, that's good. That team in itself has got the experience and it gives me the confidence. It's back to that risk element, isn't it?
Yeah.
People are worried that investors will look at someone with no experience and say, that's a big risk. and it is.
Yeah.
But this is where you mitigate it by putting the people around you who've done it before. So if you could kind of joint venture with someone who's done 24 new build houses in one go and say, look, could you come in as like the silent partner so I can just put your experience here, bolster mine, help me with this, put the team around, then that's what people are looking for. But also remember, what experience are you bringing to the party? It could be something completely different. If you are a social media whiz with a huge following, you know, what do we look at now? Who's appearing on TV shows?
Yeah, that's true.
I don't know how big Strictly is around the world, but Strictly Come Dancing in the UK is massive. And over the last few years, the people that have been coming to the show have been people with big social media followings. They have no experience of standard media TV, then they might not be well known. But all of a sudden, they're bringing a whole different tribe to look at a TV program. And people are looking at this. You might have experience and be able to bring something to the party that nobody else, the investor, has never been exposed to, but wants to be. And it might not be the experience for that particular project, but you're bringing something else. So, you know, imposter syndrome, lack of experience, it's a big one. It's a mind game. And again, me and Ray, we do go into some of that to help you overcome those mindset issues. But yeah, there we go.
Yeah, good. Good. Should I ask you or should we go with what Nigel said?
Go with what Nigel said.
Okay. So I have 2 questions left, and then there's 3 questions I ask every listener. So one is, have you seen that interest rate from the investors that they want more interest on the money, like return on the money now when different asset classes have gone up if you compare it to property, or is it still the same?
Short answer to that is it's about still the same. There are some investors that have made it quite clear. They say, I'll invest it, but I've got to get a 20% return per annum, 20% return per year. That's their criteria. Some of them are like that. And there are others that say, if I can get 5% a year, I'll put the money in for 3 years. Yeah. So it entirely depends. Some of them can be very bullish, but has it changed? Not really. Crypto hasn't affected anything. Not really. You know, they're quite switched on and they understand what's happening. Yeah. I would say, you know, an average interest rate. I mean, we had one guy who was asked to put £200,000 into a deal. The bank had already committed 800,000. He was asked for 200,000 and he was being offered 200,000 at 10%. And the bank had put the money in at, I think it was 7 or 8%. Yeah. And he said, well, why don't I just put all the money in for the 8%? He said, you know, there's no point in me. You've got the money from the bank. That's fine. But I've got £1 million. So I'll put it all in for 8%. But he'd gone to visit the guy. He liked the property. They'd had dinner and all the rest of it. And they got on like a house on fire. So instead of just putting forward the 200,000, he put forward the whole lot. So, you know, like I say, the question is, Mr. Investor, what's important to you? That's the question. What is it? You just ask and they'll tell you. Yeah.
Do you have anything to add to that, Nigel? Or?
No, I think that's fair. A lot of times investors are very canny at looking at spikes, peaks, troughs, and trying to pick the middle ground. So, you know, there may be a slight tweak of it, but they will have a return for a particular type of investment that they feel is correct for them. Yeah. And that doesn't tend to change dramatically. It might adjust slightly depending on, you know, what is it? An incoming tide raises all ships sort of thing. Yeah. So there's an element of that, but no, they will have, you know, a return in that particular thing because it's linked to the risk of that particular thing. And they tend to stay fairly constant.
Okay.
But, yeah.
Great answer, guys. So the last question before I send my usual question. Are there any red flags you should be aware of when someone asking for funding?
I was once at an event and a guy had a laminated A4 piece of paper on a string round his neck and it said, I need 50 grand. I'm not kidding. He didn't get it. So that was a red flag. Red flags, you know them when you see them. Generally, they get eliminated in pre-qualification. So what we do is if somebody says, phones me up, I usually go, oh, hi, is that Ray? Yeah, I've got a deal, but I need this and I need this, and the property's here and there and everywhere. I just say, look, stop, hang on a minute. I'll send you a link. There's 8 questions on the link. Fill in the 8 questions, send it back, and we'll get a guy in the office to have a look at it. So when people fill out that form and send it on, we eliminate a lot of people there, because there are quite a few people that have, for example, yesterday I was talking to a guy. He did a commercial conversion course. Now he has property. He's got 5 single lets. He understands single lets, but he wanted to convert it was a sort of ballroom or something. It was a huge building. I mean, it's 15,000 square foot in 15,000 square foot in just south of Liverpool somewhere. And he wanted to convert it into flats. And it was a big deal. And he said to me, I'm looking for money to do that. And I said, I'm going to stop you there. No, you're going to have to do this as a joint venture. You cannot do it on your own because you just lose money. So that's the sort of thing. And then he might go away and say, well, I don't want to do it as a joint venture. Well, we won't be sourcing funding for him, because he falls down on the credibility aspect. Now, that's before we've even got the application and tried to see what the score is, because I just know right away the score is going to be too low. So I think there's a lot of people that are enthusiastic, but they're enthusiastic amateurs, and they can be some of the worst. So we try and patch them up, joint venture them. We've got established developers that would like to work on a team just for a sweat of the brow wage, not necessarily for a percentage, but sometimes for a percentage to shore up the team. So when you see the red flags, if they're red flags that can be fixed, that's fine. If they can't, then we wouldn't do it. Yeah,
good answer. And what about you, Nigel?
It's all down to the demeanor of the person, and it's like whenever you're selling anything, you always get tire kickers. And the simple thing is that you want to, you obviously not if you're selling pets. I mean, getting people to come around and kick pets would not be good. But no, you know what I mean. You're selling a car, they come around, they kick the tires, they haven't a clue about a car, they've got no funds and all the rest of it. One of the greatest things that you can use is just ask a few questions. Just ask a few questions of the person, because they give such great answers. What are you doing at the moment? Well, I'm living under a bridge. It's not, and I jump out and scare billy goats as they cross or something like that. You're kind of thinking, right, this might not be the best person. The other thing is just quickly ask them, said, okay, is there anything in your background, anything on social media, that you wouldn't want someone to know? Said, oh, no. Well, what are you on Facebook? And just go on their Facebook whilst you're there with them and just go, oh, that's interesting, isn't it? Lying in a gutter from a night out or whatever, or, doing some crazy stuff. It's quite easy, but just throw a few questions. Those people that are serious, it's pretty obvious pretty quickly that they're serious. The thing that annoyed Ray most, which is one of the reasons why we do some help with people filling in an application form, is people would just turn up and say, yeah, I've got this thing. And you ask them the most basic questions and you realize they haven't even looked at the property.
Yeah.
They drove past it and they thought that'll do. And they're making numbers up and all the rest of it. So some of those things there, we do some stuff and just say, look, if you are serious, this is the way that you walk through to give yourself the best chance of overcoming those first hurdles. But tire kickers you can get rid of pretty quickly.
Yeah. Wow, guys, amazing answer. This is, I think people are gonna be like, whew.
Yeah, get them off.
So these are my 3 questions I always ask. So one book that you will recommend to your child or children.
Yep.
Doesn't need to be property, can be whichever. So I don't know who wants to start, Ray or Nigel, who wants to start?
For me, Rich Dad, Poor Dad for kids.
Okay.
Good one. For me, it might be Financial Freedom by Paul O'Mahony. That's financial. not financial, financial freedom.
Never heard about that one. Good one. Okay, and one book for every investor. It doesn't need to be property as well.
How to Raise Money. It's coming soon, folks.
I've been waiting for that.
I would say
high five.
For an investor. No, I'm not going to, not a book, but I would recommend a website by a very prolific investor, a guy called Nelson Gray. So nelsongray.com, Gray, NELSONGRAY.com, Nelson Gray. He's got lots of articles in there. He's probably invested in over 100 businesses. Lovely guy. He does podcasting. He also helps startups, that sort of thing. He's been in the investment game for a long, long time, and there's lots of good information on there. So it's better than a book because it's real life examples, and he's constantly updating it.
I was going to say, I just want to throw a few in. I was scrolling through, looking at some of the ones that I love. So investor or a person looking to have investment made in them. 80/20 Sales and Marketing by Perry Marshall is a very good idea there of seeing where time and effort gets a reward and what goes on. Influence, Robert Cialdini. He's re-released that because that's probably 20 years old, and he's just re-released and updated it, and that's good. And then a couple, well, Think and Grow Rich and Napoleon Hill, something like that. That's always a good one. But then I'll give you two biographies. The first one is Total Recall, and that's Arnold Schwarzenegger's story. He's unbelievable, my unbelievable story or something. And it's just incredible how he'd made himself so successful before he even, cracked movies.
Yeah.
But that, in terms of setting goals and being focused on them, and it's just a fascinating book of who he met. The other one is Shoe Dog by Phil Knight, which is the story of Nike. Yeah. Again, that is an amazing story of kind of their focus was on one thing, which was, the running shoe, the athlete and all the rest of it. And just the trials and tribulations are amazing. But if you like the way that the universe works and you put things out and they come back, the ending of that book and the symbolic tying back of certain elements and threads in that book just leaves you thinking, wow. It did me anyway. So I love those. But yeah, there you go.
And I'll leave off with two. One is a book called Beyond Billions by David Roy Newby. It's about creating lasting wealth using King Solomon's success secrets. It's very, very good. And finally, Daylight Robbery, How Tax Shaped Our Past and Will Change Our Future by Dominic Frisby. Daylight Robbery by Dominic Frisby. You can see it there, but that's...
Yeah, put it in front of your face. There you go.
Yeah, okay.
It's good. It's good as that book. He's also done some other books as well as Dominic Frisby, which are good. But the final one, I know what you're going to ask. Your favorite property book, aren't you?
Yeah, exactly.
Okay.
You beat me to it.
There you go. Well, for me, it's simple. It's a tale that you can remember. It gives you the absolute nuggets that you need. And I remember when I was at a presentation, so this was a quick question. You never get a quick answer from us. But I was at a presentation, and obviously I'm an accountant, and I was sat at the back of this presentation. It was about property. And somebody said, can anyone define, an asset and a liability? And I leant back in my chair thinking, all right, nobody is going to get the definition of asset and liability. They just won't, because it's quite complicated. It's very much the privileged world of an accountant for us to understand it and you to get baffled by it. This is my domain. Here we go. Someone put their hand up and said, an asset puts money in your pocket, a liability takes money out. And I laughed. I went, ha, like that. And everyone kind of looked at me and I thought, oh, and the person who's presenting said, correct answer. And I went, what? And then they said, yeah. And the question came up, have you not read Rich Dad, Poor Dad? And that made me think, right, okay, what do these people know that I don't? what is my accountancy blinkers doing to me? And I picked up Rich Dad, Poor Dad, read it in a day, and just went, that is probably the best definition of how you should direct your effort and your investments that's out there. It's so simple. And as I mentioned for the kids, he does a kids version, and my eldest read it a number of years ago, and he went, wow, that's really simple, and that's really clever. So there you go. Rich Dad, Poor Dad, Robert Kiyosaki.
Good book.
I'm not on commission. I should be. It's outrageous. But there you go. That's me. Ray, what's yours?
I would say Property Investing Secrets by Rob Moore and Mark Homer.
Yeah, that's a good one as well. Yeah, that's a good one. And do you have collaboration with them? You get
No.
No,
not yet. We will do. We'll do by tomorrow.
Okay, guys. Thank you very much for doing this. This has been a blast. And how can people get to reach out if someone wants to have investment from you guys? Fill in the form, or just want to follow your podcast or your journey? How can they do it? Just plug it in.
All right. Well, the podcast, I mean, first of all, thank you. We've had a great time. Great questions. It's really made us think as well as to some of those things. And that is valuable. Always keep someone on your toes to make sure you're on your A game and stuff. I think, Ray, we probably got to about our E or D game. Maybe we'll have to come back and sharpen our tools a bit, but
you're welcome.
The way you get in touch with us, well, listen to the podcast, How to Raise Money with Ray McLennan and Nigel Vest. That would be great. But you can go to the website, which is www.htrmoney.co.uk, or drop us an email, which is hello@htrmoney.co.uk. That would be absolutely wonderful to hear from anyone. We'd love feedback, and you've got to rate this show as well, folks. Jump in to the Apple Podcasts, get in there, give a rating for this. You don't need to rate us. We've got very thick skins. It's from years of people doing that. But no, come on, rate this podcast. It really helps spread the podcast to a wider audience. And as fellow podcasters, we know that we really do appreciate it. And we've struck up some really good relationships on a professional basis with people who've done reviews, who've then got in touch with us. And that really helps. It really makes people do that. So thank you once again. And we'd love to talk to anyone out there that needs any help with how to raise money.
Yeah. Do you have something to add there, Ray? No.
No, that's how to get in touch with us. hello@htrmoney.co.uk.
And there's some templates in there. There's some free guides. There's help on some of the questions that you may have. And if you want to go further, you want to go deeper, or you want to get to the point of 1 to 2, so you could get both of us if you wished. Then go to the website, get in touch with us, and let's get talking. Let's find out what you're up to, because we love seeing success of people. We love it.
Yeah, guys, thank you very much, and thank you for the plug and and taking your time. I know we went overboard, but it was so fun speaking with you guys, and so much knowledge. And I hope the listeners and the viewers will like it, and the jokes that you gave as well. So with that ending, don't be stressed. Invest, people. Bye.
Bye-bye.